Human beings are wired to run from fire, but the stock market rewards those who calmly walk toward it. That uncomfortable truth sits at the heart of every global market crisis. When prices fall sharply and uncertainty spreads, our evolutionary instincts activate. We seek safety, we look for escape, we assume danger must be avoided immediately. In most areas of life, that instinct protects us. In investing, it often sabotages us. The market is not a predator. It is a system of collective human behavior, prone to excess optimism and excess fear. When fear dominates, prices fall. When prices fall, expected future returns quietly rise. Yet almost no one feels brave enough to embrace that logic in real time. John Bogle understood that the greatest threat to an investor's success was not market volatility, but their own reaction to it. In a world obsessed with forecasting and tactical moves, his advice during crisis sounds almost radical in its simplicity. When global markets are in crisis, the headlines will tell you that something unprecedented is happening. They always do. The language becomes dramatic. Words like collapse, meltdown, contagion, and historic losses dominate the conversation. It feels different. It feels larger than anything that came before. And in that emotional atmosphere, selling feels rational. It feels prudent, it feels responsible. But markets have always moved in cycles of expansion and contraction. Fear is not an anomaly, it is part of the structure. The very reason stocks offer higher long-term returns than cash or short-term bonds is because they are uncomfortable to hold when uncertainty is high. If they felt safe all the time, they would not compensate you for owning them. Bogle's central insight was almost disarmingly simple. You do not need to predict the next crisis. You do not need to outguess the next recovery. You need to own the entire productive engine of the economy at the lowest possible cost and allow time to do the heavy lifting. When you buy a broad market index fund, you're not betting on a single company, a single country, or a single narrative. You're buying a small piece of thousands of businesses. Some will fail, some will stagnate. Some will quietly innovate and grow beyond what anyone imagined. The index does not require you to know which will be which. It harnesses the collective output of all of them. In a crisis, that ownership does not disappear. Factories still produce, software is still written, groceries are still sold, medicines are still developed. The price investors are willing to pay for those businesses may fall dramatically for a period of time, but the underlying activity does not simply vanish. This distinction between price and value is where most investors lose their footing. When your account balance declines, it feels as though wealth itself has been destroyed. In some cases, it has been temporarily repriced. In many others, it has simply been marked down by fear. If you are a long-term owner rather than a short-term trader, falling prices do not automatically equal permanent loss. The crisis exposes something uncomfortable about the way we think about money. We say we are long-term investors. We say we understand volatility. We say we believe in compounding. But when confronted with a steep decline, our time horizon shrinks from decades to days. We stop thinking about retirement 15 or 20 years away and start thinking about this week's drop. That shrinking of perspective is the real danger. Bogle often reminded investors that in the short run, the market is a voting machine, reflecting popularity and emotion. In the long run, it is a weighing machine, reflecting the actual earnings and productivity of businesses. During a global crisis, the voting machine becomes loud and chaotic. The weighing machine continues its quiet work in the background. If you allow yourself to be governed by the voting machine, you will be pulled back and forth by every wave of fear. If you anchor yourself to the weighing machine, you begin to see downturns differently. You begin to understand that lower prices, painful as they feel, represent higher future expected returns for disciplined investors who continue to own and, when possible, add to their holdings. This is where Bogle's strategy becomes both simple and psychologically demanding. It does not offer the thrill of tactical shifts. It does not promise to shield you from every downturn. It asks something more difficult. It asks you to accept volatility as the admission fee for long-term growth. Consider the alternative. If you move to cash during every significant decline, you may feel relief in the moment. Your balance stops falling. The anxiety subsides. But relief is not the same as wisdom. To succeed with that strategy, you must make two correct decisions. You must know when to get out, and you must know when to get back in. History suggests that even professionals, armed with teams of analysts and sophisticated models, struggle to do this consistently. The individual investor juggling career, family, and daily responsibilities faces an even steeper challenge. The more you trade in response to fear, the more you introduce costs, taxes, and behavioral errors into your plan. The promise of control becomes an illusion. Bogle's philosophy was built on humility. It recognized that markets are complex, information is rapidly absorbed into prices, and predicting short-term movements is extraordinarily difficult. Instead of fighting that reality, he embraced it. He asked a different question. If you cannot reliably forecast short-term movements, what strategy maximizes your probability of long-term success? His answer was broad diversification, relentless cost control, disciplined rebalancing, and unwavering patience. During a global crisis, those principles do not change. In fact, they become more important. Low costs matter more when returns are scarce. Diversification matters more when specific sectors or regions are under stress. Patience matters more when fear is widespread. This is the part that feels almost unfair. The strategy that works best in crisis is the same one that feels boring in calm markets. It does not require a special insight. It requires steadiness. And yet, in the middle of a global downturn, steadiness can feel like the hardest task in the world. You will hear arguments that the world has fundamentally changed. You will hear that old rules no longer apply. You will feel the pull to act, to protect, to do something decisive. Before you give in to that impulse, you must confront a deeper question. Are you reacting to evidence, or are you reacting to fear disguised as evidence? Because what happens next in a crisis often determines not just your returns for the next year, but the trajectory of your wealth for decades. The answer to that question is rarely found in the present moment. It is found in history. There was a period not long ago when markets around the world fell with a speed and violence that felt apocalyptic. Businesses failed. Banks collapsed. Unemployment surged. Retirement accounts were cut nearly in half in less than 2 years. For many investors, it did not feel like a temporary repricing. It felt like the end of the system itself. During that crisis, broad market indexes declined by more than 50% from their peak to their lowest point. Imagine working for 2 decades, building a nest egg through steady contributions, only to watch half of it seemingly evaporate. The instinct to flee was overwhelming. Financial commentators spoke in grave tones. Predictions of a lost decade filled the air. Now, step back and widen the lens. An investor who owned a low-cost total market index fund before that collapse and continued to hold it through the decline experienced severe paper losses. There is no way to soften that reality, but that same investor, if they maintained discipline and continued investing through those lower prices, participated fully in the recovery that followed. Within several years, markets regained their prior highs. Over the subsequent decade, they moved significantly beyond them. This pattern is not unique to one crisis. It has repeated in different forms across generations. Severe downturns are followed by recoveries. Recoveries are followed by expansions. Expansions eventually give way to new contractions. The names and causes change. The human behavior underneath does not. What makes this so difficult in real time is that the recovery is invisible while the pain is visible. When markets are falling, you can see the red numbers. You can calculate the loss. You can feel it in your chest. The future recovery exists only as an abstract possibility. It has not yet shown itself, and human beings are wired to respond to what is immediate and tangible. Consider a working couple in their late 30s who have been investing steadily for more than a decade. They contribute each month to a diversified index fund inside their retirement accounts. They have done everything they were told to do. Then a global crisis strikes. Their account balance drops by 40%. The number on the screen is lower than it was several years ago. They sit at the kitchen table at night asking the question so many ask. What if this keeps getting worse? What if we lose even more? What if we never recover? If they sell at that moment, they convert a temporary decline into a permanent loss. They move from being owners of productive businesses to holders of idle cash. The pain stops immediately, but so does their participation in any rebound. If they continue investing, something subtle but powerful happens. Each monthly contribution now buys more shares than before. Lower prices mean higher expected future returns, though it does not feel that way emotionally. The crisis, which felt like an enemy, becomes a strange ally for the disciplined saver. This is where psychology overwhelms mathematics. Intelligent people understand the logic of buying low and selling high. They nod when they hear it, They agree with it in theory, but in practice, buying when prices are falling feels reckless. Selling when prices are rising feels prudent. Our brains are influenced by recency bias, the tendency to assume that what has just happened will continue happening. If markets have been falling for months, we project that decline forward indefinitely. We also suffer from herd behavior. When friends, coworkers, and media personalities all express fear, standing apart feels isolating. Selling becomes socially reinforced. Remaining invested can feel lonely. Bogle recognized that the greatest advantage of index investing was not just low-cost diversification. It was behavioral simplicity. By owning the entire market and committing to a long-term plan, you remove the constant need to evaluate which company, which sector, or which country will recover first. You eliminate dozens of decision points where fear can interfere. The arithmetic of compounding does not reward brilliance. It rewards endurance. Imagine two investors who each begin with the same amount and contribute the same steady sum each year. One panics during major downturns and misses just the 10 best days of recovery over a multi-decade period because they were waiting on the sidelines. The other remains invested throughout. Historical data suggests that missing a small handful of the strongest rebound days can dramatically reduce long-term returns. Those best days often occur close to the worst days. They cluster together in periods of extreme volatility. The investor who sells to avoid further loss is rarely able to time their re-entry to capture those powerful rebounds. They wait for clarity. They wait for reassurance. By the time the news feels positive again, much of the recovery has already occurred. This is the quiet cost of emotional decision-making. It does not announce itself immediately. It compounds silently over years. During a global market crisis, the temptation is to treat your portfolio like a fragile object that must be shielded at all costs. Bogle's philosophy asks you to see it instead as a long-term partnership with the productive capacity of the economy. That partnership will experience periods of strain. It will not move in a straight line. But over long spans of time, businesses generate earnings. Earnings drive value. The question is not whether markets will decline again. They will. The question is whether you will allow those declines to interrupt a plan designed for decades. Understanding this intellectually is not enough. The real challenge emerges when your account balance is falling and the future feels uncertain. That is when discipline stops being an abstract virtue and becomes a daily decision. And there is one sentence that echoes through every major downturn, a sentence that sounds reasonable, cautious, even wise. It is the sentence that has cost investors untold sums over generations. It begins with 4 words. This time is different. Those 4 words carry a seductive power. This time is different. They suggest that history is no longer a reliable guide, that old patterns have broken, that the rules which govern past recoveries no longer apply. In every major downturn, that phrase resurfaces with renewed conviction. It feels thoughtful. It feels nuanced. It feels as though you are recognizing a deeper structural shift rather than blindly trusting the past. To take the objection seriously, we must acknowledge something important. Every crisis does have unique elements. The specific causes differ. The financial plumbing may strain in new ways. Technology evolves. Global relationships shift. It would be naive to claim that nothing ever changes. But here is the crucial distinction. The surface details change. The underlying drivers of long-term returns do not. Businesses still seek profit. Entrepreneurs still innovate. Consumers still demand goods and services. Human beings still strive to improve their standard of living. These forces are not erased by crisis. They are disrupted, sometimes painfully, but they persist. The belief that this time is different often rests on the assumption that markets will not recover because the damage feels too deep. Yet markets do not require perfection to rise. They require adaptation. Companies fail, but others expand. Entire industries shrink, but new ones emerge. When you own a broad index, you are not betting on the survival of every individual company. You are participating in the aggregate evolution of the economy. Consider 2 investors standing at the same crossroads during a severe global downturn. One is convinced that structural change has permanently impaired future returns. He liquidates his holdings and waits for stability. The other acknowledges the uncertainty but maintains her allocation to a low-cost, diversified index fund. The first investor feels intelligent in the moment. He believes he is avoiding further loss. Months pass. Markets continue to fluctuate. News remains mixed. He waits for a clear signal that danger is past. Meanwhile, the second investor endures volatility. Her statements continue to show sharp swings. She questions herself at times, but she remembers why she chose this strategy in the first place. Then, almost quietly, prices begin to recover, not in a straight line, not with universal optimism, but steadily enough that gains accumulate. The first investor hesitates. He worries that the rebound is temporary. He wants confirmation. By the time he re-enters, prices are significantly higher than when he sold. He has locked in his losses and forfeited a meaningful portion of the recovery. This is not a story about intelligence. It is a story about temperament. Bogle often emphasized that successful investing is not about beating the market. It is about capturing the market return at minimal cost and holding it through thick and thin. The discipline to remain invested when others panic is not glamorous. It rarely earns praise in the moment, but over decades it compounds into a substantial advantage. There is another layer to the objection that deserves attention. Some argue that broad index investing itself contributes to instability. They worry that owning everything indiscriminately ignores fundamental analysis. They fear that passive investors are vulnerable if markets misprice assets. This concern sounds sophisticated, yet it overlooks a simple reality. Index investors are not the ones setting prices day to day. Active traders, institutions, and speculators are constantly analyzing, buying, and selling. Their activity determines valuations. The index investor merely accepts those prices and owns the result. In doing so, they avoid the higher fees and trading costs that eat into returns over time. Costs are not a minor detail in crisis. They are a silent force that shapes long-term outcomes. Imagine two investors who each earn an average annual return of 7% before expenses over several decades. One pays annual costs of 1.5% in management fees and trading expenses. The other pays 0.1% through a broad index fund. At first glance, the difference appears small, but over 30 years, that gap compounds dramatically. The investor paying higher costs surrenders a substantial portion of their ending wealth to fees. The lower-cost investor keeps more of the return generated by the underlying businesses. During market downturns, when returns are scarce, high fees consume an even larger share of what remains. Now return to the emotional core of crisis. Picture a worker in her early 40s who has diligently invested for nearly 2 decades. A global downturn slashes her portfolio by 40%. She feels fear, not just for her balance, but for her future. Retirement seems less secure. Plans feel fragile. If she abandons her disciplined strategy and moves entirely to cash, she may sleep better for a few weeks. But if markets recover over the next several years, as they have after previous severe downturns, she will face a new pain, regret. She will realize that the very moment she sought safety was the moment she stepped away from the recovery. If instead she remains invested, continues her contributions, and rebalances periodically to maintain her intended allocation, she participates fully in the rebound. Years later, when markets have moved beyond their previous highs, she looks back on that crisis not as the end of her plan, but as a chapter within it. The difference between those two futures is not a secret formula. It is not privileged information. It is the willingness to trust a philosophy grounded in evidence rather than emotion. This does not mean ignoring risk. It means acknowledging that volatility is the price of admission for higher long-term returns. If you demand a perfectly smooth path, you must accept lower expected growth. There is no asset class that delivers high returns without discomfort. When someone says this time is different, what they are often expressing is a discomfort with uncertainty. They want guarantees. They want clarity. Markets do not offer those. They offer participation in human progress, accompanied by inevitable periods of doubt. The question, then, is not whether uncertainty exists. It is whether you will structure your financial life in a way that can endure it, because the real crisis is not the decline itself. It is the decision you make in response to it. Endurance in investing is not dramatic. It does not produce thrilling stories at dinner parties. It rarely feels heroic. It feels repetitive. It feels ordinary. And yet, over the span of a working lifetime, it can separate financial independence from perpetual anxiety. When markets are in crisis, the temptation is to search for a new strategy, a defensive maneuver, a smarter allocation that will insulate you from further pain. Bogle's philosophy asks a quieter question. What if the strategy you built in calm times is already designed for storms? A broadly diversified, low-cost index portfolio is not constructed on the assumption that markets will rise smoothly. It is constructed on the historical reality that they will not. The allocation between stocks and bonds is meant to reflect your time horizon and your ability to tolerate volatility. Rebalancing is meant to gently restore balance when one side moves sharply. None of this requires prediction. It requires consistency. There is a subtle power in removing the need to forecast. Forecasting invites ego. It invites overconfidence. It tempts you to believe that with enough information, you can sidestep every downturn. History suggests otherwise. The more frequently investors attempt to anticipate short-term movements, the more they trade. The more they trade, the more costs and taxes erode their returns. Consider again the mathematics of compounding. If you earn an average annual return of 7% over 30 years, $1 grows to more than $7. But if costs reduce that return to 6%, the same dollar grows to less than $6 over the same period. A single percentage point may sound trivial in conversation. Over decades, it becomes enormous. Now, add emotional trading to the equation. If you miss even a handful of the strongest recovery days because you are waiting for clarity, your effective return drops further. Compounding does not merely magnify gains. It magnifies small disadvantages. High fees and poor timing compound just as relentlessly as disciplined ownership. This is where a surprising reframe emerges. Volatility is not a defect in the system. It is the mechanism that creates opportunity. If prices never fell, future expected returns would be lower. If investors never panicked, bargains would never appear. The discomfort you feel during crisis is directly connected to the long-term return you seek. Most people spend their careers earning income through effort and time. Investing allows you to put capital to work so that businesses generate earnings on your behalf. But that privilege comes with a condition. You must accept that the value of your ownership will fluctuate, sometimes dramatically, even when your long-term thesis remains intact. During crisis, remind yourself of what you actually own. You own shares of companies that design software, manufacture goods, build infrastructure, provide healthcare, and distribute food. You own human ingenuity expressed through commerce. The daily quotation of those shares is influenced by fear and optimism, but the underlying enterprise continues. None of this eliminates risk. Companies can fail. Economies can stagnate for periods. That is why diversification across industries and regions matters. That is why maintaining an allocation to high-quality bonds can provide stability and liquidity. The goal is not to eliminate volatility. It is to structure your portfolio so that volatility does not force you into destructive decisions. If you are decades away from meeting your investments, a downturn can be viewed through a different lens. Each contribution you make during lower prices acquires a larger ownership stake in the same productive system. The crisis becomes a period when future returns are purchased at a discount, even though it feels uncomfortable in the present. For those closer to retirement, the focus shifts to appropriate asset allocation and withdrawal planning. Bogle never advocated reckless exposure to risk. He emphasized knowing your need, your ability, and your willingness to take risk. A well-designed plan accounts for downturns in advance. It does not rely on hope. There is also a quiet advantage in simplicity. A complex portfolio of narrowly focused funds invites constant evaluation. Each holding becomes a separate source of anxiety. A total market index fund reduces the mental clutter. You are not asking whether a particular sector will rebound first. You are allowing the entire market to work on your behalf. At this point, you might notice something unexpected. The strategy that feels passive is actually deeply active in one crucial sense. It is an active decision to resist emotional impulses. It is an active commitment to evidence over narrative. It is an active embrace of humility in the face of uncertainty. If you value clear thinking in a world saturated with noise, consider making that a permanent part of your financial life. Surrounding yourself with rational perspectives during turbulent periods is not weakness. It is protection against your own worst impulses. Global market crises will come and go. Your career will advance. Your savings will grow. Your portfolio will fluctuate. The question is whether you will allow short-term turbulence to derail a long-term plan built on decades of market history. The investors who ultimately succeed are rarely those with the most sophisticated predictions. They are those who build a simple framework and then refuse to abandon it when emotion surges. The irony is almost poetic. The very moments that feel most dangerous often contain the seeds of future growth. but only for those who remain present long enough to experience it. When you first feel the heat of a market crisis, it is hard to believe that calm will ever return. The headlines feel relentless. The losses feel personal. The uncertainty feels permanent. At the beginning of this conversation, we acknowledged a simple but uncomfortable truth. Human beings are wired to run from fire, yet the stock market rewards those who calmly walk toward it. Now we can see that the fire in investing is rarely destruction of the entire system. It is the burning off of excess, the release of fear, the repricing of risk. What makes this so difficult is that crisis compresses your time horizon. You begin to measure your success in weeks instead of decades. You open your account more frequently. You calculate losses in dollar terms instead of percentages. You imagine worst-case scenarios with vivid detail. The long arc of economic growth fades from view, and yet, if you widen the lens, the pattern reappears. Over very long periods, broad markets have trended upward, not because optimism is constant, but because productivity advances. Businesses create value, workers innovate, capital is allocated, sometimes poorly, often efficiently. When you own a low-cost index fund, you are not wagering on perfection, you are aligning yourself with that broad trajectory. Bogle's genius was not in predicting crises, it was in designing a structure that could survive them. By owning the entire market at minimal cost, you eliminate the need to identify the next winner. By keeping expenses extremely low, you retain the lion's share of whatever return the market delivers. By rebalancing thoughtfully, you systematically trim what has risen and add to what has fallen without relying on emotion. In the middle of global turmoil, these principles can feel almost too simple. Surely something more dramatic is required. Surely there must be a lever to pull, a defensive posture to adopt. But complexity often masquerades as control. Simplicity, when grounded in evidence, can be far more powerful. Think again about the working couple who watched their portfolio fall sharply. If they held their diversified allocation and continued investing, the years that followed likely included both recovery and new highs. Their account balance did not rise in a straight line, it zigzagged upward. But the trend, over time, reflected the earnings of the businesses they owned. If instead they had surrendered to fear and abandoned their plan, the damage would not have come from the market alone. It would have come from their decision. The market decline would have been temporary. The loss from selling would have been permanent. This is the quiet distinction that changes everything. Markets can recover from crises. Investors who permanently exit often do not fully recover from the consequences of that exit. None of this suggests blind optimism. There will be periods when returns are muted. There will be stretches when patience feels unrewarded. That is why expectations matter. If you expect steady gains every year, volatility will feel like betrayal. If you understand that volatility is woven into the fabric of equity investing, downturns become unpleasant but not shocking. The final insight is less about markets and more about identity. Are you a trader reacting to daily price movements, or are you an owner participating in long-term enterprise? Traders require constant vigilance. Owners require conviction and time. When you choose broad market ownership, you are making a statement about how you believe wealth is built, not through frantic motion, but through sustained participation. Not through forecasting the next crisis, but through accepting that crises will occur and structuring your portfolio accordingly. Global markets in crisis do not demand brilliance. They demand discipline. They test whether your philosophy is sturdy enough to withstand emotion. They reveal whether your allocation truly matches your risk tolerance. They expose the gap between what you say you believe and what you actually do. If you can remain steady when others panic, if you can continue investing when prices fall, if you can focus on decades rather than days, you transform crisis from a threat into a chapter. A difficult chapter, perhaps, but not the end of the story. The world will experience future downturns. Headlines will again declare unprecedented danger. Predictions will again sound certain and dire. When that happens, you will face the same choice investors have faced for generations: react or remain. Bogle's strategy offers no guarantees about next year. It offers something more valuable. It offers a framework that has endured across wars, recessions, bubbles, and crashes. It rests on the humility that markets are hard to outguess and the confidence that broad human progress, though uneven, has historically rewarded patient owners. The fire will flare again. Prices will fall again. And in that moment, when your instincts urge you to run, remember what you truly own and why you chose to own it. Sometimes the bravest move in investing is simply to stand still